Today, MicroStrategy scoops up more than $147 million in Bitcoin in August. Hackers steal $200 million from a Hong Kong crypto exchange. And former FTX U.S. President Brett Harrison explains Architect, his new digital assets-focused company. Welcome to CNBC's Crypto World. I'm Kate Rooney. Cryptocurrencies in the red to kick off the week. By noon Eastern, Bitcoin traded around $26,200 and Ether traded below $15.90. Aptos, the token for Web3-focused blockchain, launched by Aptos Lab, was a bright spot this morning, rising more than 4%. Okay, let's talk about some of the top stories. First, MicroStrategy keeping to its promise of buying more and more Bitcoin. Michael Saylor, the company's founder and chairman, announced on X that the software company bought more than 5,400 Bitcoin in August. He said that at average prices, that comes out to more than $147 million. The company has amassed more than 158,000 Bitcoin, worth a little less than $4.7 billion since it started buying Bitcoin back in 2020. Next up, Mixin, a Hong Kong-based decentralized network, just lost hundreds of billions of dollars in a hack. It's according to a post from the exchange on X. Hackers attacked a cloud service provider for the network early Saturday morning, and Mixin said initial verification showed about $200 million were involved in that hack. The network has now stopped deposits and withdrawals, which Mixin says will reopen once a fix is confirmed. All right, for our main story today, Brett Harrison, the former president of FTX U.S., has a new company aimed at bringing more efficient infrastructure to both digital assets and traditional markets. I caught up with Brett to learn more about his vision for that company and bringing these two worlds together, plus his thoughts on the FTX bankruptcy. So, Brett, most people know you from your time at FTX. We'll talk a little bit about that, but you have a new venture called Architect. Give us sort of a primer on what this company is and what you're building here.
So we are a financial technology company building infrastructure for trading across digital asset markets and regulated derivatives markets. In addition, we just recently received approval from the National Futures Association for a CFTC introducing broker license for regulated derivatives under the CFTC. So we're a combined technology provider as well as a derivatives brokerage.
So you're registered now with the CFTC, is that correct?
That's correct,
okay.
Yes.
And not just crypto, so you're doing both. Explain that strategy of kind of crossing over to traditional equities and derivatives as well as crypto.
So the primary place where institutions enter any new asset class is through derivatives for various reasons, including capital efficiency, the ability to go long and short. And that's not just true in the digital asset markets, it's true in the equity markets, the fixed income markets. Much of the institutional liquidity occurs on the derivatives markets, the futures and options. And so what we want to do is not just bring the ability for people to trade in efficient ways in digital asset markets. We want to bring much of that technology to the traditional asset markets as well. In our view, over the long term, the line between what is a digital asset and what is a traditional asset will blur, and it's important for technology to be able to support both in a unified way.
What are institutions doing right now in crypto? I wonder if you could give us an overview of the appetite for digital assets. It seems like that's slowed down and trading volume has stalled a bit, at least on the retail side. What are you seeing from your vantage point?
Obviously, starting earlier this year, volumes really came down in the digital asset markets. But more than that, we're starting to see volumes from institutions shift to different market centers. There's a lot of new players now that are entering the space, both from the trading side and from the exchange side. I mean, you have exchanges like Cboe, who now they have their Cboe Digital Exchange, not just for spot, but they also recently received approval for margined futures on Bitcoin and Ether. And that just sort of shows how in this kind of shakeup, given everything that's happened, there are many traditional players now that are entering the space and looking to try to create structures that feel more like the regulated structures that we see in the equities and futures space. And that combined with kind of the growing kind of appetite for getting back into the space as things died down from everything that's happened the last year, I think we're going to see those volumes pick up in a big way over the next 6 months.
So are institutions moving into options and derivatives because there's not as much available on the spot side. I just wonder what that's about, or is it just they're looking for more alpha there?
It's a combination of both. So in the U.S., the primary place where institutions are getting exposure to the underlying asset is through the CFTC-regulated futures and options markets, because those are the places that feel, from a technology and from a regulatory perspective, very much like the other assets that they're used to trading. They don't have to worry about taking custody of the underlying asset. At the same time, there are people who can trade in the underlying assets, on a market like Coinbase or Kraken, and they might want to either hedge their exposure using something like futures, or they might be engaging in some kind of arbitrage or basis trading strategy where they might go long futures, short spot, or vice versa. And so there's a number of different reasons why people are primarily transacting in the derivatives. And obviously, when we've seen recently the fervor over a spot Bitcoin ETF, there is much interest from institutions in finding different, whether it's in the equity derivatives or the futures derivatives side, to be able to engage in the market of digital assets.
What would the impact of a spot Bitcoin ETF approval be, at least on the institutional side?
I think first it would significantly increase the exposure that institutions would be able to get and would want to get to the underlying digital asset markets. I mean, as we know, the primary place that people get access to, for example, the S&P 500 liquidity would be through something like SPY as an ETF. I mean, people are not picking individual stocks as much these days. And the same thing would be true for an ETF on something like Bitcoin. I think that in addition, it would probably increase volumes as a whole across the spot digital asset markets as well. I mean, think about the authorized participants in the ETF markets who would be creating and redeeming this ETF to match the institutional demand and the retail demand. And as a result of that activity, they would end up kind of buying and selling the underlying spot asset to be able to create those and facilitate those creations and redemptions. So I think as a whole, it would probably do a lot to kind of bring interest and volume back to the digital asset markets.
It also seemed to help Bitcoin prices, and it has sort of stalled out as the Fed appears to be holding rates higher for longer, and the macro picture really has been affecting crypto prices, it seems like, more than some of these idiosyncratic news stories. What's your take on where markets are, what's driving prices, and what crypto needs to see any sort of sustainable recovery?
So yeah, we saw a bump in prices after it looked like, for example, Grayscale won their lawsuit, and also the kind of mixed results on that Ripple lawsuit at least showed that there was appetite to consider digital assets like spot XRP as not an investment contract in certain circumstances. I think people need to see more regulatory clarity, more kind of courage from Congress to be able to push through actual legislation, either to enable regulated stablecoin issuers or to actually put in place a broad framework for how digital assets are going to be regulated under some combination of the SEC and CFTC to really see that next bull market in the US. However, still outside the US, the sentiment is much more positive in places like EU, Hong Kong, UK, where there is significant appetite for creating regulatory regimes that clearly spell out how actors in the market can either be brokers or traders or facilitators of digital asset trading in general. And I think that kind of combination of the global positive sentiment will eventually bring this market back.
What was your experience working with regulators and trying to get the approval that you announced this week?
So for us, we had a very, what we thought was a productive time working with our person at the National Futures Association on this particular application. I think that in this market, the important thing is to kind of walk through the front door, to work with regulators, to have those conversations, to be able to actually bring regulated businesses to the US. I think long gone are the days of trying to engage in businesses in the trading and markets world while looking for either no action or trying to kind of get around the rules. Ultimately, in order for something like a new asset class like digital assets to thrive, there will need to be actors in the space that have significant kind of financial and regulatory experience, that are working directly with regulators in either the SEC, the CFTC, or other government agencies to be able to kind of bring clear, kind of protected activities to either retail or institutional participants, and that's what we're trying to do as well.
Are regulators more skittish in the wake of what happened to FTX? I wonder if that came up in any of your conversations.
It didn't come up in ours. I mean, I think for people trying to do new digital asset activities, absolutely. I think the appetite for creating either new market structures or letting people list new kinds of assets definitely waned in the wake of the FTX Celsius collapses and everything else that's been happening over the last year. What we're doing, obviously, is we're starting not in the digital asset space from the regulated activity side, but we're working with the kind of vanilla regulated futures and options on things like commodities, stock indices, currencies, and these kinds of activities are just this very clearly defined path for how one gets licensed to be able to offer those sorts of market instruments to participants.
It's really interesting that you're doing both, that you're sort of going at the traditional equities future side as well as crypto. I do want to ask you about FTX. It's almost been a year since that really started to unravel. Sam Bankman-Fried, your former boss, heading to trial in a couple weeks here. What's your feeling on the FTX bankruptcy almost a year later?
With the trial coming up, it's sad and it's disappointing on a personal level. I mean, thinking about not just the hard work that we tried to do on the FTX U.S. side, all the colleagues, all the customers that were affected, but mostly the fact that even a year later, this is still going on, this trial is still going to happen, and that Sam hasn't yet been able to take responsibility and receive accountability for his actions up to this point. And the fact that it's sort of dragged on this long to the very bitter end with this trial, I think is not, as a result, we haven't really been able to get closure in the industry. So I think all of us, watching what's going to happen unfold over the next, 4 to 6 weeks are looking forward to some closure on this whole ordeal.
You recruited some former FTX colleagues, is that right, to build and work at Architect?
Yes, there's 5 different employees that used to work with me at FTX U.S. that are now working with us at Architect. Fascinating.
Well, we're excited to hear more about it going forward. Brett, thank you so much for joining us, and we'll see you soon. Brett Harrison.
Thank you so much.
Founder of Architect. Okay, that's it for Crypto World today. We'll be back again tomorrow with a lot more. We'll see you then.